Hey everybody, Brian Shannon here from alphatrends.net. It's Friday, the 7th of August, 2015. Markets had some selling this week. The S&P 500 lost 1.2%, Nasdaq 1.5%. Russell 2000 got hit a little bit harder, and as we'll see in a moment, closed below the 200-day moving average, losing 2.5%. Semiconductors continued lower. They're down close to 6% now year to date. Financials struggled a little bit and did squeak out with a little bit of a gain for the week. And oil got hit the hardest, and then biotechs got hit hard too, while the bonds rallied. So let's take a look and make some sense of all this action. The S&P 500 continues to be in the middle of this range that we've seen throughout most of the year, and we did come down and test the 200-day moving average. We've seen closes just above that 200-day moving average 2 weeks in a row now, and what you'll start to see here in the next couple of weeks is that 200-day moving average is going to start to flatten out a little bit. This is where we were about 200 days ago. So we're going to start to replace this data over here with new data in this area, which will cause that 200-day moving average to flatten out. And that is a reason to think that that risks may be getting greater. We don't have a breakdown, so we're still in this range, and that's what's important. But within that range, we're seeing a lot of volatility. And this week in particular, we saw a key level of intermediate term support broken at 209. So once that broke, it kind of confirmed to me that we were in a bearish intermediate term phase. And we were talking in Alpha Trends about this trend line and this triangle that's kind of developed in there. We also spoke about the volume weighted average price since the lows that we saw in July, and from this low right here, the volume weighted average price. So up near 209, really between 208.75 to 209 right now. I consider this market highly suspect in the intermediate term as long as we remain below 209. We're going to have to get back above 209 for the market to become intermediate term more neutral. And as well as hitting the 200-day moving average and holding it, we also came down to the year-to-date volume weighted average price once again. So this is telling us there's been a lot of indecision in the market this year. We're basically on a price to volume adjusted basis. We're basically flat right here in the S&P 500. So you'd have to be a fool not to be concerned about the longer term trend of this market. We've had this massive bull market, and one of the things that people say a lot that kind of is a little bit of an uneducated saying is that it's going to end badly. And if you have a plan, if you manage risk, it doesn't have to end badly for you. So what we're going to focus on is that trend line and this level of support. If we break below that, then what's going to happen, of course, we'll start to see that 200-day moving average flatten out and then turn lower, and we'll have to start looking at this market with a different scope. That is one of a more bearish basis. But as long as we remain above this level, the longer term trend that we've seen this year, when I talk about longer term trend, I'm saying basically since early February, that we're pretty much neutral here. And simply, we do not know if this is distribution before a decline or if perhaps we're going to build some energy for a breakout. There's no use trying to guess that when we're in the range. Typically the sideways action will be resolved in the direction of the primary trend, but then you have to consider how long that trend has been intact and what's going on underneath the surface. And underneath the surface, we're losing some leadership from stocks, obviously like Apple, which are Apple's below its 200-day moving average right now. But at the same time, we've got some super strong stocks like Netflix, which continue to break higher this week. We've lost a little bit of ground from Tesla this week, and stuff like Alibaba continues to be garbage, as does Twitter. Twitter continues to be in a downtrend. You can talk all you want about when their CEO might be changed or whatever the reason for buying is, but the stock came public at $26 a share, and it seems like it's magnetized to at least that level. Perhaps next week in Twitter we see a flush below $26 a share and then a reversal, but the momentum remains clearly bearish here. We're below that declining 5-day moving average, and it's just a messy chart. Not really, besides a couple people who bought underneath this line here today, no one who bought the stock after it came public and is still holding is in a profitable position. This stock has lost a lot of money for a lot of people, although of course there are short sellers in here who are doing well with it, and the short sellers are wise for being short because it's in a downtrend. Don't bet with your heart, bet with what the stock is telling you. Back to the market, the Nasdaq. I pointed out a perhaps troubling setup in here. That is that if we take a look at the semiconductors back in June broke out to a new high. They pulled back to the 50-day moving average. Then it appeared as though they were making a higher high right here. At that point, this market really failed. So those semiconductors often lead the Nasdaq. And what we've seen in the Nasdaq is we had that breakout. We saw it pull back to the 50-day moving average. It looked like it was breaking out again this week. And now we're right on that 50-day moving average. And we have to be aware of the possibility that this market does continue the way that the semiconductors is. I'm not saying that's what I expect. I'm going to trade what unfolds, but you have to be aware of the potential for that scenario. Today we got down to a little bit below the lows of the last month or so, and then we're able to bounce a little bit. But until we get back above 111 next week, if we can get back above 111, it turns it more intermediate term neutral. But right now, the intermediate term, you have to look at this with a very skeptical eye and think that we are guilty till proven innocent. Meaning I do expect further downside if we cannot get back above and hold above 111 in the Nasdaq 100. Where could it go? Well, perhaps we see it all the way down towards this level where we were just a month ago and testing the 200-day moving average. The Russell 2000 has had a similar type of bearish scenario where it let's look at the daily time frame here with the 50-day moving average. It has made this pattern of lower highs and lower lows. So we've got a declining 10, 20, and 50-day moving average. We've got a pattern in the Russell 2000 of lower highs and lower lows. And this market, the Russell 2000, excuse me, had been the leader. Now it's only up 0.22% year to date. So that's reason for concern. Now the 200-day moving average is still advancing. However, similar to the S&P 500, this was the action about 200 days ago. That will start to flatten out here a little bit. I don't think that we're topping yet because we're still, or we have evidence of a real top, that is, because we're still holding above this prior band of resistance. So it's tricky in here. There's no doubt about it. It's tricky. But over the last month and a half, 2 months, we've seen a downward bias in this market. Call it a bearish trend. Whether it's a bear market or a bearish trend depends upon your time frame. But as we mentioned last week, these were the key levels. We were going to talk about it staying guilty till proven innocent unless it could get back above 124, that it would have to get above and hold above 124 for it to just become neutral and then build a little bit of energy and break from there. Obviously, that didn't occur. Instead, we saw resistance at that 124 level. And then, of course, on Thursday, we broke this little band of support from this week. And let's take a look at that on a 10-minute time frame. So on this 10-minute time frame, we've got the 5-day moving average, which is clearly declining. And what we did not see was a pattern of higher highs and higher lows above the 5-day moving average. So we've got a couple of bands of resistance just above. 121.5 to 122 is really the more important intermediate term. If we get up towards that level, I would not suggest shorting the market, but I would say be aware that there's the possibility of reversal in that area. So if it begins to reverse from that area, then you want to take your cues and short. You don't look at it and say that is resistance. We'll only know if it's resistance after the fact. So we wait for it to get up there, look for evidence that it's starting to decline, and then short the market with a stop above the most recent and relevant lower high, which would probably be about 122 or so. So we're looking at this with a skeptical eye. We are below the 200-day moving average, but we've also lost some good ground here, so perhaps it just begins to stabilize. The fact is, I don't have a crystal ball. That's not what technical analysis is about. It's not about predicting what's going to happen next. It's about assessing what the probabilities are and being in a position where we say the risks are worth being long or short, or if it's too murky, then we stand on the sidelines in cash and wait for things to become clearer. And we have a great market of stocks. Again, we've got, stuff like Apple declining massively. We've got Amazon in a great uptrend, Google in a big uptrend, Twitter in a downtrend, Facebook in a uptrend. So there's a lot of opportunity on both sides of the market. Your job is to find the ideas which make most sense for your personal time frame, and that's what I help people with every single day in Alpha Trends. So let's take a look now at those semiconductors. Again, they are a broken group. They've broken this important level of support that we had seen forming this year. So realistically, below 53, basically 52 to 53 is this prior band of support. We remain guilty till proven innocent. The weekly time frame is really pretty ugly in here. Now we have the possibility that we bounce a little bit, but is it a high probability bounce scenario? No, definitely not. If they don't scare you out on the way down, they will generally wear you out. And we had seen that in gold. We'd spoken, over the last couple of years at length about the downtrend in gold, and that just turning sideways is not a reason to buy when we still have a longer term declining 200-day or 400-week moving, 40-week moving average rather. It means that the longer term pressure is still to the downside in the gold market. So don't bother trying to look for the bottom. It's very similar to right now what we're seeing in oil, that oil had experienced this massive decline earlier in the year. We had seen a little bit of support forming. It had a decent bounce from 40, basically these levels, 43, 44 up to 60, but then it broke the support and it's continued to go lower. It seems as though oil is on a course to at least test that low, if not break below it, and it's had a decline here of the last month that's pretty significant, 25% basically, right? So we look at that and say, is that a reason to buy because it's down a lot? No, there are still sellers in this market. There is no reason to buy a market where the sellers are in control. It's otherwise you're just gambling. Have an edge, have a strategy. The financials, as we noted, had squeaked out with a gain this week, and this group, I think, as long as they hold above this 24.80 to $25 a share in that 50-day moving average, they are in better shape than the rest of the market. However, we do see similarities here as well, that we came down and tested the 50-day moving average, rallied, and then looked like we were breaking out. But now it's holding up better certainly than the Nasdaq, and it's holding up better than the semiconductors did when they broke their important levels. So financials, I'd say give them the benefit of the doubt on the longer term time frame, but it's getting a little bit murky in here as well. When we look at a 30-minute time frame, you see that we tried to break beyond this intermediate term level of resistance. It was unable to hold, and the sellers came back into the stock. So now I think intermediate term in this range, we're probably neutral, $24.80 to $25 a share. But if we break below that, to me, I think it brings up the danger of a bigger decline, perhaps down towards the 200-day moving average and $24.50 a share. The biotechs got hit this week, and they are very similar as well to the semiconductors. So they broke out to a new high. They pulled back quickly, rallied up, looked like they were making a higher high, and then failed very quickly. So again, to look back at the semiconductors for that same type of pattern, this is what we're talking about. This is that similar little break, and then it came down. You have to take this seriously. It's not a roadmap, but it's a potential scenario, and that's what technical analysis allows us to. On the bright side, we've got this level that it was tested that had been a prior band of resistance. It seems to be holding in there for now, but there's definitely some damage done in the biotech, so take it seriously. They've had a massive advance over the last several years, and obviously when you have something appreciate that much, there's going to be some profit taken. We'd seen a couple weeks ago, of course, that Biogen had gotten hit very hard, and that continues to be under pressure, whereas a stock like Amgen tried to break out and is starting to fail a little bit. Celgene, it broke out and it's starting to give back some of those gains. It's still obviously in a longer term uptrend. Celgene is and Amgen, but they are showing signs of a little bit of fatigue. So take the signs seriously and figure out where it makes sense for you personally to set your stops.